Good evening, everyone. Time for another silver update. You're looking at the 8-hour US dollar Japanese yen chart, and as I pointed out at the Fukushima disaster, that we had a liquidation of the US Treasury bond to support the investments that were necessary to restore all of the damage that was done to the Japanese infrastructure from the tsunami and the following meltdowns, etc. So we had a central bank intervention that occurred right at the bottom of this, and we had a big rally. But you can see from the trend line that I've drawn on the volume that we're still looking at the dissolution of the yen carry trade. So we're plumbing new depths here with our current price at 78.53. If we go all the way out to the weekly, we can see we're into new lows, and we're just below these lows that we established in 1995. So the dollar is collapsing against the Japanese yen, and I think it's going to go much lower. But the last chart that we had with the volume shows that right after Fukushima occurred and the central bank intervention occurred, you can see that we pretty much flatlined at a much lower average volume price than we had before that. And what that means is the yen carry trade has pretty much collapsed. So I think the yen's going to continue, well, the dollar yen's going to continue down. The dollar's going to continue losing value against the yen and probably go down to 50 or so in the long run. We'll have to wait and see. So let's pull up the silver chart. And we had a very interesting day today. We had kind of a smackdown, and we'll go to the 5-minute because we've been monitoring the volume on the 5-minute. You can see we had some nice spikes. We had a spike of 10,000 contracts and one earlier of 7,500. Nothing to compare to the 12,000 that we had, and always we want to go back to the huge sell-off spike of 50,000 that occurred back here. So what is interesting is that the low that we reached with the 50,000 spike has now been surpassed, and if we close above this price, which is 41 roughly, if we can get above that price, then this volume here and this volume here and this volume here will end up being buying volume. Even though this volume came in on a downdraft, a price penetration above this point will show us that all of the buying and selling added together actually is positive on the buying side. So I wanted to use that as an opportunity to segue into completing my discussion of the open interest issue. And some of the things I said in the last video were a little confusing, so I wanted to clear those up. My main point was that volume and open interest are not necessarily correlated, and we'll first pull up the open interest and volume for today, Friday the 22nd, and we had a volume of 53,000, and you can see our open interest fell a little bit to about 58,000. So today, as opposed to yesterday, we actually traded less volume than open interest. But I want to jump over to the latest article I have on open interest. I'm going to read some of this, but I encourage you to read the entire article. This is the best article I found because I continue to do my research on this. This article is called Open Interest, Everything You Wanted to Know and Some Things You Never Asked For. And this is very informative, so I'm going to read a little bit of it. Open interest, the number of outstanding contracts in a listed derivative. And don't be thrown off by the S&P 500 E-minis. this also applies to futures. While many traders follow action in the S&P 500 E-minis as a proxy for the overall market, only a handful of these traders track and interpret open interest figures. By knowing how many futures contracts are being created or closed out on a daily basis allows a trader to gain a second layer of understanding to complement his or her analysis of the price action. To begin our discussion, let's discuss how contracts are created and how they are closed. There's a neat little chart here. Sell long, sell short, buy long, and cover. And this is no change and no change, a negative change to open interest, and a positive change. So here's the explanation. In the matrix, we can see four separate scenarios: one in which a contract is created, one in which a contract is closed, and two neutral events. First, a contract is created when person A buys one contract from person B, who then becomes short one contract. Bottom left quadrant. If person A sells his or her contract to person C, it is simply a transfer of ownership and no contracts are created or closed. Top left quadrant, 0. Similarly, if person B covers his contract and person D shorts the same contract, there is no change in open interest. Bottom right quadrant. Finally, let's return to our original example where person A is long one contract, person B is short one contract. If person A sells his contract to person B, thereby allowing him to cover, the contract is closed and open interest decreases by 1. And that's this quadrant. On the surface, a change in open interest seems like a market neutral event. One individual is getting long while another is getting short. However, the indicator takes on significance in the context of market direction. First, let's examine the implications of open interest figures in a rising market. Refer back to figure 1.1. This scenario favors the bottom left quadrant. While it is true that every contract bought is met with an equal number of short contracts, the fact that the market is moving higher suggests the longs are price takers and the shorts are price makers. This implies that the traders are aggressively getting long and willing to lift offers. On the other hand, if a market is rising as open interest is falling, it implies that the shorts are being squeezed and are aggressively covering their positions. So I encourage you to read this. This is the best explanation I've found. It explains how open interest rises and falls, what open interest is, and why you can't just look at these volume spikes, because you can't determine from the volume how many of these people were initiating new positions, closing out old positions, churning existing positions, etc. The variables are infinite. So that's the last I'll say on that issue. And I wanted to segue into my channel real quick here. I have not had time to address a lot of the comments that have been on my videos. I've done a video a night and I work full-time, so I have limited time to address the comments and the critics, etc. So I wanted to show you. I want to thank, first of all, the people who made my silver update Caught in the Act go viral, which is at 28,731 views. As you'll note, I don't have any revenue that I generate from this channel because revenue sharing is not enabled on this channel. It has to do with complex copyright issues, and I just decided to turn that off. I have a number of people who are donating to me. If you go to my homepage, you can donate Bitcoins. That's really the only way you can support my channel. If you don't have Bitcoins or don't understand them, I understand. So that's really not important to me because this isn't a channel about making money. It's about educating people. So I wanted to thank the people who have promoted my videos and made them go viral. If you'll notice at the top, we have an announcement from YouTube, and if any of you watch Alex Jones, you'll remember some of his videos about how YouTube numbers have been messed up. So YouTube has come forward and admitted that their numbers they're not incrementing accurately. I really don't care. It doesn't matter to me either way, but it's just an interesting issue. So wanted to take you over to my Insight. If you have a YouTube channel, you have Insight, and that is the statistical analysis of all your videos, and you have a number of things you can analyze here. I want to jump to the subscribers and to the 7 days. Seem to be having a problem here with the statistics. Anyway, if you go to my subscriber amounts on the 7 day, we'll just take this and let it update when I go to the next thing, but you can see that my subscribers I have 3705, and I've gained about 300 or 400 subscribers in the last few days. So I just really appreciate the people who promoted my channel and the videos. It's not something that is a monetary reward for me, because I don't really have any revenues connected to this, and I don't have any blogs connected to this channel. It's really just an opportunity to educate people about the tremendous opportunity that silver offers. So we'll let this go ahead and update. There's something wrong with the connection, but I want to jump to the main topic I was going to address today, and that is the debt limit cap debate that we've currently been having. So I want to take you over to a spreadsheet that I've created, and what I've done is I'm trying to explain the current debate about the debt limit cap raise in terms that people can understand, because there's so much propaganda out there about this. And the first thing I want to point out, I pointed out in previous videos, is this term about default that they're always throwing about. And this is a completely false analogy. There's no chance or reason for default. The only way there would be default is if Geithner specifically chose to default. There's plenty of money, and I'm going to go through these numbers to show you the money. What I've done is I've taken the income and debt numbers and I've reduced them by a factor of, I think it's maybe 1 million, it's 1,000, 100,000, whatever it is. What I've done is I've converted the numbers that we're currently using for the nation to a budget of a person who just lives an ordinary life. So you can see how these numbers convert. These are the numbers that I used. The income that we currently have from taxes is 2.2 trillion. I just converted that to 22,000. And it goes on down the line. So I'll name the numbers that we have in our national budget, and then I'll show you how I converted it to a spreadsheet of a typical budget that a person would have. So currently the U.S. has an income of 2.2 trillion. We are currently expending 3.7 trillion. We're running a debt, a total debt of outstanding monies that we owe, 14.3 trillion. That's nothing to do with entitlements. I'm sorry, that's nothing to do with the deficits of projected things in the future. That's just the current budget. And we have interest of 3,000. That's actually 300 billion that we pay. By the way, that's an interest rate of just a tiny fraction. The next column is something I'm going to use to project what it would be if it were a person, so we'll skip that. And then we've got 19,000, which represents 1.9 trillion, which would be the 2.2 trillion in income that we get from taxes minus the 300 billion interest that we have to pay on the existing $14.3 trillion of debt. So first of all, looking at these three figures, you can see that default is ridiculous. There's no reason to default. We could just simply take 300 billion of the 2.2 trillion that we get every year and pay off our interest. Now that would only leave us with 1.9 trillion. So we're currently spending 3.7 trillion. So it's pretty obvious that if we were serious about dealing with our debt, we'd have to cut this number in half. If we cut this number in half to about 1.85 trillion dollars, and we have a disposable income after our interest payment of 1.9 trillion, we'd be in the black. Now, that means a 50% across the board cut to all government expenditures. That includes the military, that includes Social Security, that includes every department in the government, and all salaries of all government employees. That's everything we pay cut in half. So those are the numbers, but I wanted to look at what this would be like if this was an individual's income. So this would be an individual who makes $22,000. This is an after-tax figure. We're just going to say they have take-home of $22,000. Now every year they have to spend $37,000. They bring home $22,000, but every year they live at a level of $37,000 standard of living. So every year they're going into debt to the tune of $15,000 above what they make. Now they have an outstanding debt of $143,000, and their interest payment on that $143,000 is $3,000. So after you take the $3,000 from the $22,000 that they make, they only have $19,000 of disposable income to live every year. So obviously they don't have to default. They could just live on the $19,000, and they'd have to severely cut this $37,000 that they spent. So they pretty much have to cut their expenses in half to live within their budget. Now, the interesting factor here is that this interest that they're paying, they're only paying $3,000 a year interest on $143,000 worth of debt. Now you can see that's pretty absurd, because if this really were a credit card and someone owed $143,000 on a credit card on an income of $22,000, it's highly likely that the credit card companies would raise their interest rates significantly, because the risk of default is growing very high. So the way I generated this realistic interest rate column was that I took rough interest rates that you see on credit cards, and sometimes they spike as high as 30%, but I set this one at 20%. So if we take 20% of this $143,000 and say that's the amount of interest we have to pay a year, that comes to $28,000 a year. So we have an income, disposable income of $22,000, and our interest is $28,000. So you can see the realistic disposable income for this family is negative $6,000. This family is bankrupt. And the United States is bankrupt. The only reason why this shell game continues is because of this column. Because this family is one that actually has a pipeline to the credit card companies that are loaning them money, and because of that they have a ridiculously low interest rate that they can set, and they're in essence bribing the credit card company with money they don't have to keep their rates low and keep them from being in bankruptcy. But realistically, this family is bankrupt. So what they should do is default on this debt, call it zero, and tell them they're not going to pay them a penny back. They should cut these expenditures and hopefully they would find another source of income, but we don't know that. So this is just taking the national debt numbers on a realistic budget scale for a family, and you can see that it's already game over. So the debt debate that we see today is really, it's just a charade. The game is already over. The government is already bankrupt. But because you're dealing with a government that has the world reserve currency and also the most powerful military in the world, you're looking at a situation where the politicians are agreeing together to kick the can down the road, to push things off to the next guy's watch, and hopefully have the insolvency occur when they're not in the position to take the blame. And we'll talk to you next time.